Welcome to the Risk Reversal Podcast. I'm Dan Nathan. That's
Guy Adami in the flesh.
There he is. We're doing it here. Guy, we're having a little vibe session. This is what we do Wednesday afternoons for the Thursday morning drop.
Vibe session.
Yeah, we structure a lot of things.
I learned about vibe coding recently.
Yeah, you did. That's a thing.
I don't know what it means.
Well, if you were like one of those old nerds who used to like code all night, you don't shower, you just drink Mountain Dew all night, that sort of thing, you get all hopped up. Do the do. Now these some of these models are allowing for you just to do much less coding to get the same
so you watch it code.
Possibly. Okay, we got three things to do today, guys.
Let's do all three.
We got a lot of market volatility. We're not going to bury the lead because we're going to get right to that. But the other things we're going to talk about is we have the Fed minutes out today. We have the Jackson Hole, Kansas City Federal Reserve confab. That's Friday morning. Fed Chair Powell speaks at 10 a.m. And then let's kind of talk about retail earnings, what we are hearing from these companies. This is the last batch of earnings that we've got during this season.
Retail week. So what have I learned? Well, I learned what I think I already knew about Target is that, in a word, they suck.
Yeah.
And this is something we've been saying for a while. And I know we talked about the Who earlier in this week with Elizabeth Thomas, but meet the new boss, same as the old boss. Well, that's what's going on at Target because the successor for Mr. Brian Cornell is a lifelong Target person. So I think the market was hoping for some sort of change. And I think one of the reasons the stock sold off in the way that it did is because they didn't get said change. And, you're just sort of shuffling the deck chairs, in my opinion. Now, maybe given the amount of volume the stock has traded on this sell-off, maybe you can start looking at it for the first time in a while for a trade. I mean, if you think about it in terms of the stock itself, this is probably a 6-year or so low in terms of Target. A stock that made its all-time high, as you know, in the fall, late summer, early fall of 2021, and has only cascaded lower ever since. Compared to like a Walmart, which has historically been their biggest competitor, Walmart's effectively at an all-time high. So you have to ask yourself, as much as it speaks to a consumer that's probably in some state of difficulty, this is all Target-specific stuff. Now, I'll mention this quickly as well. TJX, which is a name we talk about often on this show, in the same way we talk about Walmart, that's a stock that made an all-time high of 145 and change before pulling back a bit. So it's not like the entire retail sector is strapped. They're winners and there's losers.
Yeah, and don't get caught on the wrong side of the line. The one thing I would say to you, Guy, about the TJX. I don't know what that is. Come on, dude. Atlantic City, Bruce Springsteen. There's winners and the losers. Don't get caught on the wrong side of the line.
Why would you want to be on the wrong side? Yeah.
Well, he's just saying don't get caught on it. I mean, that's kind of the key there. The breakout in TJX is astounding, right? It got right back up. You said 135 to that prior high from May. It gaps up the open, Guy. The open is 143 and a half. Okay, trades as high as 145 and a half. And here we are, though, 139 and a half. So it's basically given back a lot of those gains. It doesn't look too different if you're listening to this and you're sitting in front of your FactSet machine. Check out what Microsoft did after its earnings. It gapped a massive gap to an all-time high, closed on the low that day, and hasn't really seen an uptick in a few weeks. So that's just an interesting setup to me. And I think the meet the new boss, same as the old boss with Target. When you look at the poor execution, and this stock, to your point, traded $270, okay, in late 21, and now it's trading basically at $100, and a lot of it was execution. A lot of it was poor inventory management and the like. But man, like to be that tone deaf and say we're going to replace the CEO with a guy who's been there his entire career. I bet you they kind of get rid of the corporate jets though at this point.
Well,
Guy. What do you think?
I would hope.
I heard they had a nice one. By the way,
I know people that spent a lot of time on it. I know. Had bullish commentary on the stock on the back of that.
Right.
That's called selling or currying favor. True that. I've never been a fan of that. But you said again. I'm not looking to bitch slap or pick on Target here, but it's deserved, and it was time for a change. And you just said it. Operationally, they're doing everything wrong. I mean, they're zigging when they're zagging. This new CEO, I think, to your point, you said it, is a bit tone deaf, and they still have operational failures in the form of inventory problems. I mean, they've been mismanaging it now since, listen, I think everybody should have gotten a pass in COVID in terms of some of the inventory things. I get it. But a lot of companies figured it out from that. And some companies actually looked at their actual businesses and said, wait a second, maybe we should take a deep dive here and really go down and look at the supply chains and look at the different things. I'm not sure the Target did that.
Yeah, and this comes down to a board, in my opinion. I'm just looking at their board. There are 14 members, Brian Cornell, one of them, actually 15. The average age on this board, Guy, is like 66 years old or something like that. Predominantly men. There's a couple token women in there, one way or another. And I say that, I don't say that dismissingly. You know what I mean? I say that there's not a lot of representation on these corporate boards by females. We've kind of gone through that over the last few years or so. But again, not to belabor the Target thing. I mean, it's just poor execution, to your point. One thing I wanted to hit though, Walmart and Costco. Neither one of these companies, have been performing particularly poorly in this environment, especially in front of, this trade situation here. You would expect both of these companies to be able to navigate a lot of these supply chain issues, to navigate kind of passing on the tariffs to some of their exporters, right, rather than them eating it and having to pass through to their consumers. But it is interesting that Walmart, which was a behemoth, if you go back and you look at a 5-year chart of the stock, you would have thought that they were the ones that made the Hopper GPUs or something like that, right?
Well, they didn't make the Hopper GPUs, but they definitely utilized AI as well. And we've talked about this, but it's worth mentioning again. Outside of Facebook, I think Walmart's done the best job in sort of implementing and getting a return on their investment. And for the case of Walmart, it's in the form of margins, which have substantially improved. But please.
Yeah, by the time you're listening to this, you're going to see what Walmart reported, for this current quarter here and the guidance that they gave. And really, I think more importantly, just the commentary they have on a consumer, because we've been talking about this trade down from a higher end consumer down to Walmart for the last couple of years or so. So it'll be interesting to see if there's any stress in that level of the consumer. But the other point I just want to make here, Guy, is that even though the stock was trading very near all-time highs just a few weeks ago, which basically was the same level where we were in mid-February when the stock was 105. It got as low as $80 in the lows in April. And, it never broke out and made a new high. It never confirmed all the new highs in the S&P that we saw in July and June, I guess, too. What does that say to you? Maybe it's more about investor appetite for these sorts of names, because was there just a last gasp, and we're going to talk about some of these names that have been the darlings of the market. Was it just the last gasp of folks piling into the AI trades and then kind of neglecting some of these sort of, I guess you call them staples, if you will.
So, I mean, if you were, and I do remember this because into earnings back in February, we did market call, we're doing fast money, and we told people, we cautioned people, we said, look, they're going to have to say something extraordinary in order for this trajectory to continue to the upside. And neither one of us thought that would happen. We thought the stock could sell off. And that's exactly what happened, because right after they reported earnings, the stock was 105 and change, to your point. It traded down to about 93.5, 94, which made perfect sense. Held there, bounced for a couple days, and then, like everything else, cascaded lower into April. What I find quasi-interesting, and I think it's important, it's made almost the entirety of that move back, and here we are at 102 and change into earnings. So a couple things. That prior high is clearly a bullseye. You need to close above that. I think if we were to get there and fail, you're going to have technicians talking about this short-term double top, which I totally get. You have no valuation cushion whatsoever, which has been true for a while. If you recall, a few months ago, CNBC was running with the fact that Walmart had 7 or 8 or 9, 10 days in a row of trading lower. But what we were quick to point out is, yes, that was true, but the magnitudes of the move were small. I mean, it wasn't like it was going down percentage points a day. And basically within a couple days, it got that entirety back. So I look at Walmart and say it's hanging in there like a champ. And there's a lot to like here outside of valuation. I'll remain bullish, but more so sort of cautiously here, and that's a word I don't like, only because that 105 level is staring me in the face.
All right, let's talk about the market volatility over the last couple of days. Yesterday the S&P closed down 1%, the Nasdaq closed 1.5%. The follow through into today on Wednesday was really interesting. Right out of the gate, guy, they started selling the things that they were selling hard. Yesterday, at one point, I think the Nasdaq was down, nearly 2%. The S&P was down a little more than 1%. Here we are. There is 40 minutes left in the trading day. The Nasdaq is down 65 basis points. The S&P looks like it's on its way to being unchanged, down 15 basis points. Let's take a minute and just kind of focus on, to me, what was the main driver of the tech sell-off, and that was Palantir. Yesterday morning, Citron Research, short seller, came out with a note basically suggesting that if OpenAI is raising at $500 billion, this Palantir makes no sense at this valuation, said it should be worth $40. This is something that you and I have talked about. We don't have to kind of get into the specifics. We've just been saying it, 100 times sales and a $435 billion market cap. It just doesn't make sense. The stock can never grow into that valuation. Well, today, after being down 9% yesterday, we were down nearly 10% today, and the stock right now is down 1.5%. So this thing is setting up for a massive spike bottom. What does that mean? Yesterday, down 9%, closes on the low. Today, gaps lower than yesterday's close, makes a huge move lower on big volume, and now it's going to close on the high of the day. You would expect follow through into tomorrow. Guy, at 25% from its recent highs, that's where it was this morning. Is this the sort of thing where the momentum could take it right back to those prior highs?
Absolutely. Without question, we've seen it before with the broader market. Dan Ives had a piece out, and I think we're going to talk to Dan in the next couple of weeks that, buy Palantir on this sell-off. And, okay, that's fine. $40, is that unreasonable? Well, let's do a little bit of a math game. $40 is basically 25% of where it's trading right now. Let's just use 160. So 25% of the market cap at $360 billion is a $90 billion valuation, which makes price to sales at least a little more reasonable. So it's not, in just terms of the math, it's not crazy. And I will tell you, there was a period of time where Palantir bulls were wishing for a $40 stock. Yeah. So everything is, you got to look at things in context. I don't think it's going back to $40. I will tell you, though, I think there's a very good chance it gets back to about 115 or 120. So could it bounce given the last couple of days and the fact that big volume day and we're bouncing off the intraday low that we saw today? And I think the intraday low today was about 143. Absolutely. But I think there's some real valuation headwinds out there. And I think more and more people are going to start to come to the conclusion that, wait a second, if the market is as overvalued as you think, Palantir is going to be one of the top 5 names on the list to get out of.
Yeah, and that's one of the ones when they report, I guess in, a month and a half or so, if they don't show meaningful upside after a move like this, you have to say at some point you have to start discounting that future growth because it's already in the valuation like we just talked about.
November 10th, I think they report in early November,
okay,
so we got a lot of time.
Okay.
I mean, this is a company that, $4.5–5 billion a yearly revenue has been sort of the bogey. Maybe it gets up to about $6 billion. So you obviously have revenue growth. I'm not going to discount that, but $360 billion divided by $6 billion. I mean, that's an extraordinary valuation in terms of price to sales. No matter what lens you look at it through.
Yeah, it would also be amazing to me, Guy, if we just kind of make back all these losses in the next few days. It just shows that, I think this probably has to do with the fact that retail just doesn't get shaken out. They just kind of know how to buy that dip. And, they love a handful of these names and they can't quit them. Yesterday, Liz Thomas and I spoke on the Risk Reversal podcast. It's in your feed as of Wednesday. And she talked about a broadening out trade. Now, you and I go back and forth on this, right? The whole notion of a broadening out trade, you're going to see the small caps do better. You're going to see, some of these more cyclical names, right? Catch a bid, that sort of thing. I mean, I'm of the belief that's fine. Have a ball. Go into some of these underperformers, especially if you think that this, roaring bull market needs to kind of get more participants, that sort of thing. But they can't move the indices in a way, you know what I mean? Like, look at what we just saw that was like the tail wagging the dog here. If you get these top 10 names going higher or lower, that's going to drag drag the indices one way or another. But if I look around right now, Guy, and I see, banks caught a bid, I'm looking at some industrials caught a bid, there's some staples, money's coming out of, utilities coming out. It's kind of classic rotation sort of stuff. What do you see when you see rotation like this at a relative high, right? Is that bullish or bearish the way you think about it?
I don't think you're seeing the rotation in a meaningful way that the market needs to have. And there's the old saying, live by the sword, die by the sword. And basically, if you're going to ride the wave of the broader market on the back of 8 stocks taking it there, you're going to die on that same, die on that same battlefield, because unless you get that participation, the other stocks just mathematically can't do it for the broader market. And I think that's what we're really talking about here. And it's been a great run of, again, a handful to 8 names driving this entire train. But you start losing some of that leadership, and it almost doesn't matter what these other names are going to do, because they're not big enough to make up the difference.
Yeah, no doubt. All right, let's switch gears a little bit. So the Fed minutes came out today, and I guess this is not that surprising. So you saw that most of the voting members, or those that were in the meeting, I guess last month or so, were kind of not in favor of lowering interest rates at the July meeting. Now that's changed a little bit for September, but I guess the main takeaway here is that they were highlighting the risk of inflation outweighing the concerns of a labor market, which in many ways is very odd, because a year ago at this very time, as the Fed was convening in Jackson Hole, the concern was more towards the labor market and less about inflation. And if you look at the middle of that, what has happened? Well, trade war has happened, right? And so it almost feels like we were using this term a lot in April when we saw the markets just careening and, the dollar, getting killed, and we saw yields all over the place. We're like, this is kind of an own goal, if you will. And
I didn't understand what that meant.
Yeah, it's like,
and then you taught me, you said when you go to football at Wembley, when a defender would have kicked the ball back to the goaltender. Well, it could be any sport, guy. The goalie's out there.
Yeah, it could be any. Well, it could be your loved hockey. It could be ice hockey. You could have an own goal in hockey. Well, you could do. One could do it.
I've seen that. You know where you don't care. I know about this, but you know where you do see it from time to time. If there is a penalty called, and there's something in hockey called a delayed penalty.
Correct.
And then your goaltender leaves the ice so you can get an extra skater.
Correct.
Because once the opposing team touches the puck, the whistle blows.
Yep.
However, I have seen times where a player will make a pass to a defensive partner that's not there, and it's like, OMG, that's going to go in the net. So that is what they call a what, Dan?
Own goal. That's actually worse than an own goal, actually. You know what I mean?
Well, I've seen it happen.
Yeah, no, I know. So here's the most interesting thing that comes out about this. Okay, so fine. We're in a different spot here. It has to do with trade. Maybe it's like self-inflicted. That's not fixing itself right here, okay? And the worst case scenario, I think, for everybody involved, whether you're in the administration who wants inflation to go lower, right? Or you're just a consumer, or if you're like a manufacturer, you don't really want to see inflation get back going again, because if you really want rates lower, that doesn't help the cause. But the thing that stuck out to me, Guy, is that the minute showed a discussion about financial stability, with several pointing, this is from Bloomberg, to concerns about elevated asset value pressures. So that is interesting to me.
You haven't seen that in a while.
Yeah.
And that goes back to sort of Greenspan days, when some of the commentary you heard.
Irrational exuberance.
Exactly.
You know what year that came out?
96.
And you know what happened?
Is that right?
Yes.
96?
You know what? I think in December. You know what happened
went
for
up
the next
2.5, 3 straight years.
4, I think.
So yeah. But it doesn't mean he wasn't wrong in his assessment. It just means things can last a lot longer.
Yeah.
But this is the first hint of that you've seen for a while, where I think they're taking a look at things and saying, you know what, a lot of these things don't make a lot of sense in this environment. But you're right. Inflation risks outweigh everything else. I happen to agree with that. I do think the labor market is probably strapped, but I think the inflation problem is going to remain. They also said that tariffs, you have not felt the effects of tariffs yet in terms of that inflation problem, which is something else we've said for a while, which only means that inflation problem is just going to sort of, on the margins, get a little bit worse. So I think the Fed is right to hold serve. You said this is an administration that wants lower inflation. It's an administration that will tell you inflation is low enough. That's not entirely true. I mean, there are things that obviously people are not happy about out there. So you can tell me all you want that inflation is under control. I see what's going on. I think most people do as well. And I don't think it's a particularly rosy picture. So Fed's dual mandate, stable prices, low inflation, full employment. They still think inflation is the biggest problem. I happen to agree with them.
Yeah, you know what's interesting? I've gotten this question a lot from folks that are not in the markets, don't stare at screens the way we do every day and talk about them all day long. They're like, why is the stock market trade? Forget the last 24 hours or whatever. You know what I mean? Why is the stock market acting so well? Because everyone else, if you're just, if you're worried about job security or wages and you're worried about inflation and paying for groceries or just kind of being unhappy about like even services inflation, that sort of thing, you're like, you look at the stock market and you see, in the newspaper every day, the stock market makes a new high. Where's the disconnect, right? And so when I think about it a little bit is that earnings for the first half of this year came in better than expected. We saw an acceleration in GDP in Q2. Now, granted, Q1 was negative print, okay? And you're seeing basically a consumer, and you've made this point, that's been dealing with inflation. Maybe it's through credit, that sort of thing. But what's going on in the stock market or investors are saying the worst of inflation, the worst of trade is behind us. And there is no evidence of that. And so if last year tariff rates were 2.5%, and right now the effective tariff rate or
about 16%,
I think it's a little higher. I think it's almost 18% or so. There's got to be some adverse effect in the economy sooner or later. So if we think about, earnings were better than expected in the first half of this year. In Q2, you had GDP better than, you had a stock market that, is 25% off of those lows. At some point, something's got to give, right?
We've said that for a while. Again, in April, when I think the lead was 150% tariffs, I don't think anybody thought that was, I think for a period of time, the market got spooked. Then I think people came to the realization, okay, they're just going to sort of put out a ridiculous number and they're going to work backwards. To your point, these tariffs have been 2.5%, 3% for as long as I can remember. What we've sort of landed on is 6x-ish. You want to call it 7x, whatever. Let's call it 7x of what we've been. That is not priced in terms of inflation. That's not priced in terms of who's going to pay for it, in my opinion, at an S&P at all-time highs. To your point about, though, people just being not complacent, but I think they feel they're bulletproof because what they've learned is, you know what? If the market sells off, it's going to be short-lived and there's no reason to push the panic button. It's just going to give us the opportunity to buy more of the things that we want because they have not felt the pain. April was a 3, 4, 5-day period of time where there was some consternation around the market, but just as quickly as it came, it went away. And I think people learned the lesson that we're not gonna get spooked next time. And that might be, by the way, that might be the right course of action. It might just be a market that is going to grind in perpetuity based on cash flows, but history says something else is going to happen.
So you're saying we won't be fooled again?
Well, I said that earlier, but we can say it again.
Did you say that?
Meet the new boss, same as the old boss.
Yeah.
And that
it's an extension of that.
It's an extension of that.
So here's the deal: if we
pick up my guitar and play,
if we start seeing the volatility bands in the stock market widen, and that's what we started to see over the last, call it 2 days or so. Let's just say we close okay today, but let's say there's a reason to sell the market off tomorrow, and let's say late next day we're kind of rallying because people want to cover shorts right into, let's say, Fed Chair Powell's speech on Friday morning. That to me is not bullish when you have that sort of
square up.
Yeah. So, but here's the thing, once we get through the Friday morning speech, on the 29th, we have the Fed's most favored inflation
PCE
reading. Yeah, that's PCE. And then we get to September 5th, Guy, and we have the all-important August
jobs report.
Right. And then mid-month, we're going to get, you ready for this? The less favored
CPI.
CPI, then PPI, and then we have the Fed meeting. So if you think that September is going to be a snooze.
And by the way.
Yeah, what else do we got?
This time next week, we're going to be hearing from NVIDIA.
Oh, yeah, the 27th.
Yeah.
That's correct. Okay, so September 7th.
Throw that in the hopper.
So September 17th is the Fed meeting. So just give me a sense of how you're thinking about
25 basis point cut, baked into cake, I think pretty much. I can't speak to the commentary, although these minutes suggest that they're going to remain somewhat hawkish. So you call that a hawkish cut, whatever it is. But this is, I can continue to come down. And by the way, Doug Cass has made this point, and I've made it as well. I'm not saying I got it from him, nor am I saying he got it from me, but it was this time last year. It was August last year, and I think at that time the S&P 500 was about 1,000 points or so lower, but maybe it was 5,500, so 900 points. The market was pricing in for 2025 in August of 2024 6 rate cuts. We've subsequently rallied those 900 S&P points. Now we're hoping for 2, and people are getting excited for the fact that we're going to. My point is, like, that is all that enthusiasm around the Federal Reserve, in my opinion, has already been priced in. That's just me. So 1 cut this year, 2, I think JP Morgan said maybe 4. So I don't know how they get there. I don't know if it's 25, 50, 25 type of thing, but to me, that's already in the cake.
All right, Guy, I'm not trying to tee you up. This is an expression that you use all the time, right? So what do you think the implied move in the SPY that's trading at 639 right now? So that's the SPY is the ETF that tracks the S&P 500. It's trading right now at 639. So if you took the at-the-money straddle, the at-the-money call, and the at-the-money put, you put the premium together, you divide by the strike price.
A lot of math here, but you continue.
What do you think? That's how you get the implied move between
what duration?
It's September 19th that catches all of those events that we just talked about there, right?
2.3%.
Oh, really? All right, so it's almost 3%.
Oh, I'm low.
Okay, you're low.
Light.
You're light, but I mean, I think what you're going with is what I'm kind of going with here.
Not nearly enough.
Correct.
Not nearly
So that's
enough.
why I kind of led the witness a little bit.
I mean,
a little bit.
I'm surprised it's as high as 3%.
Really? Why?
But it should be. I think your point is well taken that given everything that's going to happen over the next less than 31 days, like 26, 27 days, should be a lot higher given where we are.
All right. So the TLT, this is the ETF that tracks the 20-year Treasury. Right, Guy? So if it's going up, that means that yields are going down. Okay. What do you think the implied move? All right, you ready for this? TLT is trading at $87. Okay, let's go to September 19th expiration. It catches all of those events that we talked about. What do you think the implied movement in the TLT is between now and then?
Maybe that's my 2.3%.
Well, again, it's 2.9%. Okay,
exactly like the S&P.
But that's not normally the case.
No.
Okay, so that's also the point I'm trying to make.
I don't know the answers to these
But again,
questions.
I wasn't trying to tee you up.
No, I know. I'm fine with that.
you get my point.
Yeah.
It's they both put them together, and it actually speaks to an environment that doesn't seem like it's pricing in enough risk.
I should have listened to what I said earlier because I spoke about the level of complacency and the resilience and the bulletproofness that market participants feel that they have. And that's why I sort of skewed those numbers lower. But
we made the same point.
We're in an environment now. I mean, we're just talking about the economic stuff going on. I mean, there's all kinds of geopolitical stuff that's been swirling that I don't think it's going to resolve itself nearly as quickly as people think, and that is clearly not baked into the cake.
So, and this is, I promise people, our very last thing, and I think that's a great point. So, President Trump goes to Alaska, meets with President Putin. People were generally pretty unhappy about how that meeting went and came back. Okay, so then that was Friday, and Monday we have all these European leaders come with the president of Ukraine to Washington and that went pretty well, actually. So all these European leaders, they kind of treated Trump the way he likes to be treated. So did Zelensky, and it came out feeling like, okay, that's better than expected. But here's the point. You just said it, the geopolitical stuff that might not work itself out. Look at how the Trump administration has used tariffs, whether it's with India or Brazil or some of these other folks that are meant to be our allies, being punitive about it for things that they don't like going on politically. Okay, this is the point I'm trying to make. So in Jackson Hole, here's an article from, this is from Bloomberg here, Guy. Central bankers are gathering in Jackson Hole to defend Jerome Powell against relentless attacks from President Trump. Fears that central bank independence could be undermined. This is the Bundesbank president saying independence is part of the DNA of central banks. Also, European Central Bank President Lagarde and Bank of England Governor Bailey are expected to voice their strong support for him and warn of the dangers of elected officials putting pressure on monetary policy. Those are kind of related. Like, what if Trump gets really pissed about that and decides to ratchet up tariffs, with these sorts of... So that's the connection that I just wanted to make. Does that make sense?
Makes a lot of sense. And they're clearly not happy specifically with India, but China falls under that as well.
Yeah.
They think that India's getting a free ride in terms of being able to buy Russian crude oil and those types of things. So, yeah, the stage is set. And it also is set for more vitriol on the back of this Jackson Hole. You're going to hear about why are they out in Jackson Hole, Wyoming, what is going on. I mean, the headlines sort of write themselves. These central bankers high up in the mountains determining our fate when real Americans are hurting here. They're not able to buy a home. I mean, it's going to all happen over the weekend, and it's going to get ratcheted up. And I think if he was alone, if he had his way, President Trump, Jerome Powell would have been gone a long time ago. I think somebody got in his ear, or a collective got in his ear and said, it's not going to wind up, the result that you want is not going to manifest itself. If you do this, it's going to disrupt the markets. And I think he heard that. But he's still pissed off, in my opinion, from Jerome Powell lowering rates in September of last year ahead of the election, thinking it was entirely political. I am not of that view. There are other people that are, but I don't think he ever got over that. And I think that is still sort of simmering, and we'll see how it plays itself out. And if he doesn't hear what he wants to hear in terms of whatever comes out of this, and if he doesn't hear or see what he wants to see in terms of rate cuts in September, yeah, I think that rhetoric's going to get sort of pushed up a few notches.
Yeah, so again, the next couple days might be as interesting as the last couple trading days. Maybe you see a follow through. The market ripped right back. Some of the leadership ripped back. It looks like Palantir, with 20 minutes left in the day, might close up on the day. If you saw a follow through tomorrow, maybe you see some profit taking, and then you wait and hear what Powell has to say. And then at that point, Friday could be a very volatile day. Summer Friday, meant to be quiet, might not be, Guy.
But it makes it fun, and it keeps us working, and it keeps us doing these podcasts. And historically, this is a time of year where, as quiet as it should be, it's anything but.
All right, my man. Well, we will see you guys tomorrow. We have Stuart Sopp, the CEO, co-founder of Current. He's going to kind of help us wade through the U.S. consumer a little bit, talk some macro, the whole shebang, Guy.
Stuart he can sort of run the gamut. Yeah. He's as deep as he is wide.
There you go.
And I'm not talking about his stature.
We'll talk about that. We'll talk that with him. All right. Thanks, everyone.